Hello my fellow gurus and welcome back to the channel to a video where I will tell you about a little book that claims to offer a perfect formula to make you beat the market with a few simple steps. I know this might sound a bit too good to be true, but this is really what the author Joel Greenblatt's bestseller, The Little Book That Beats the Market, is all about. Today we'll discuss some key aspects of the book and we hope some of you find this somehow educational, entertaining or at least inspiring in some way. At Invest Like a Guru we are regularly making research video about investment strategies, and today we're going to take a good look at one of the most well-known methods to finding good companies to invest in. Well, by good companies I mean companies that earn a lot of money but are trading at a low price on the stock market. This really is the key to understanding Greenblatt's book. There's a phrase that kind of sums it all up in there. What you want to do is buy good companies at a bargain price. According to Greenblatt, this will eventually make you beat the market, but before we get into that part, you'll have to get an understanding of some basic principles presented in this book. So let's get started. And by the way, don't worry if all of this about buying companies at cheap prices will make you think, oh no, this is not for me because I know nothing about economy or finance. I don't even know math maybe, so how would I be able to calculate these financial ratios? Well, the good news is you don't need to know a lot about either of those things. This is for anyone. It can definitely be appreciated by people who just started investing recently or basically know nothing yet about it. The book is relatively short. It's entertaining and it's written in a clear and simple language. Actually, the book was originally inspired by a desire of Greenblatt's to give his children a gift. He would be writing this book so that they could learn how to make money themselves. The idea was to explain in a simple way how to become a successful stock market investor. In the first chapter of the book, Greenblatt uses the idea of a young guy named Jason who is selling gum at school to illustrate some basic aspects of business and company evaluations. Greenblatt is very much a believer in value investing. In his book, Greenblatt claims that in order to really beat the market, although it's pretty hard to do so, you want to find good companies at bargain prices. So that Greenblatt is actually saying is that the market is not always successful at valuating companies itself. Looking at the stock market, you'll find that the valuations of companies fluctuate much more quickly than they could ever do in reality. Prices can fluctuate pretty quickly due to the expectations and emotions of investors. Because of this, it is sometimes possible to buy companies relatively cheaply compared to what can be defined as the actual value of the company. Now the question is, how do you find companies of good value? And how do you find the right stocks to invest in to get that annual return of 30% on average? If you ask Greenblatt, he'll say, that's quite simple. Greenblatt has a magic formula, which he claims can make you beat the market. Yeah, I know it may sound a bit funny, but this is actually what he states in the book. It appears that the formula actually works. It works on companies of all sizes and it has been tested extensively over long time frames. In order to fully understand the magic formula, we need to get an idea of two financial ratios: price to earnings and return on assets. You'll want to invest in companies with a lower price to earnings, also called PE, which means they are trading at a cheaper price compared to how much money they make. Also, you'll want to invest in companies with a high return on capital, also called ROC. This is simply because those companies are more efficient at making money. Maybe they are able to sell their products at a higher price, maybe their brand is more popular, or perhaps they're just better and more experienced at running such a business, making higher outputs at lower costs. Now, the magic formula tries to find companies that have the best combination of a low PE and a high ROC. Actually, it's not completely true because Greenblatt likes to use something called earnings yield instead of price earning. This is the actual magic formula as described in the book that you see here. We'll not go into details about all of these right now, But it is important to note that these financial ratios differ a bit. Price earning can be used instead of earnings yield, just to keep it simply for now. The point is that companies that earn a lot on its assets or on its capital are very special. Not many companies are able to do so. Those companies have the opportunity to invest some or all of their profits in new assets, which will contribute to higher rates of earnings growth. This makes a lot of sense. If a business is highly profitable compared to the money it has to work with, then it must be healthy and growing. Greenblatt also notes that companies with a high return on capital are likely to have some sort of special advantage that keeps competitors from destroying the ability of the company to keep a high rate of earnings. The magic formula automatically excludes companies that are either too expensive, meaning their valuation is too high, or companies that are making poor returns on their capital. How does the formula actually work? Well, to explain the magic formula, imagine two lists. On the first list, you have companies that are ranked from high to low by their return on capital. On the other list, companies are ranked from low to high by their price to earnings. They are giving a number for the rank, meaning the first company on the list gets a 1, the second a 2, and so on. By multiplying the numbers of the two lists, you'll get a ranked list of companies with the best combinations of a high return on capital and a low price to earnings. The list goes from low to high numbers, so the stocks with the lowest numbers has the most so-called magic factor. As you can see in this figure, Regeneron Pharmaceuticals has the best score according to the principles of the magic formula. It has the lowest price earnings and the highest return on capital. By the way, this is just an example we made up, pretending that these 10 stocks are the only ones we can choose from. Arrow Electronics has a lower price earning, but it has a lower return on capital, so it gets a second place. Apple has the highest ROC, but in terms of price earning, it has a relatively low score, so in this case, it competes with AutoZone for third place. Try doing this task with, let's say, 1,000 or more stocks, and you'll get a pretty nice list that will help you identify some of the stocks that return the most at the cheapest price right now. The more stocks you put into this calculation, the more precise your results will be. Now, we kind of know how the formula works. Then it's time to generate a list of stocks. Luckily, we don't have to make the calculations ourselves. There's a website called magicformulainvest.com where you're able to generate a list of 30 or 50 stocks to invest in. The website collects data from thousands of stocks and is updated regularly. The idea is that you go into the website every year, generate a list of stocks and simply investing them with an equal amount of money. You're going to sell each stock after holding it a year, then repeat the whole process again and again for many, many years. That sounds easy enough, doesn't it? But wait a second, does it even work? How will I be sure that my investments actually beat the market? Well, the answer is you'll never be sure that you'll end up beating the market. Remember, the past performance is stock of and strategies is no guarantee of future returns. Investing involves risk and the possibility of losing money. That's it. However, according to many years of testing and academic research following a strategy like the magic formula, you can perform significantly better on your investments than the average market. But you'll have to look at the bigger picture. Prepare for some downturns and focus on the longer-term performance of your investments. Now, let's take a look at some results as I mentioned. The performance of the strategy has been tested out and compared to the general stock market. And we'll now try and have a look at some of the results presented in the book by Greenblatt. According to the book, you could have made 30.8% return a year on average by simply following the magic formula starting in 1988, continuing all the way to 2004. This is quite impressive. The test was done based on 3,500 of the largest companies available for trading on the major US stock exchanges. The 30.8% annual return is made by investing in the 30 stocks that ranks the highest every year. Looking at the middle row, you will see the performance of those 3,500 stocks all in all. This is an equally weighted index, meaning each of those 3,500 stocks contribute equally to the return. The S&P 500 performed an average of 12.4% in return in these years, slightly higher than the market average of the 3,500 stocks, but not even near the magic formula portfolio. Remember, the S&P 500 index is a market-weighted index, which means stocks with a larger market cap is counted more heavily than smaller stocks. So according to this table, the magic formula performs more than twice as good every year compared to the overall market. The magic formula portfolio only had a single year with a negative return, but then in 2003 it almost made 80% return. However, the magic formula tells you to put an equal amount of money into each stock, selecting only 30 stocks each year. You would assume this portfolio to be more volatile and riskier than the 500 and the 3,500 stock portfolios. It most likely is, but we'll go into further details with that in another video where we are testing it more thoroughly. Now, you might still be a bit skeptic about the whole thing. Can the strategy really be this efficient at beating the market? Joel Greenblatt was probably asking himself the same question at some point and decided to test out different factors that could be affecting the results. What if the magic formula portfolio only included the 2,500 largest companies, or perhaps just the 1,000 largest companies in the US, excluding the small cap companies? Well, either way, it's still outperforming the market significantly. This is a backtest run on Magic Formula portfolio consisting of the largest 1,000 stocks in the US. The time span is the same, the middle row is an equally weighted index of those 1,000 stocks, and the last row is the S&P 500. Still, the Magic Formula made an impressive result. However, in this test, excluding small cap companies, it lost about 8% of its annual return on average. Perhaps one of the real advantages of the magic formula is its ability to identify smaller, overlooked companies with a high return. But even by completely eliminating the smaller companies, the strategy still outperforms the market significantly. Another test done by Greenblatt in order to make sure the magic formula isn't just a coincidence is to test out 10 different groups of stocks. A list of 2,500 companies is ranked from 1 to 2,500 from best to worst, according to the magic formula principles. These 2,500 companies are then divided into 10 equally large groups of 250 companies. Group 1 will contain the 250 best companies, and Group 10 will contain the 250 poorest companies, according to the principles. Now, take a look at this table. The magic formula seems to work. From 1988 to 2004, the annualized return of Group 1 outperformed Group 2, Group 2 outperformed Group 3, and so on and so on. This is perhaps the most important evidence showing that the formula actually works. It seems that Greenblatt is right. Stocks that have the higher return on capital trading at the cheapest prices tend to perform best. Simple as that, at least in the time span here tested. If you don't wish to put your money into this strategy right now, well then don't worry, because you might as well just use the magic formula as a screener for inspiration. Maybe this formula will get you some good ideas for future investments. You could run some screens for a number of stocks and then choose the ones you like. Make it fit into your own strategy. There seems to be a tendency that stocks of cheap companies with high returns relatively to the money they have to work with perform better than the overall market. At least this has been proved to be true by testing the magic formula extensively over a long time frame. Now, as conclusion here, the magic formula seems to work well on the long term, at least in the years we have seen tested here. The magic formula often doesn't work for several years in a row. Most investors won't or maybe can't stick with a strategy that hasn't worked for several years in a row. And for the magic formula to work for you, you must believe that it will work and maintain a long-term investment horizon. Now, In the upcoming videos, we will try to test Greenblatt's magic formula on some other time frames. Many of his tests are ending back in the early 2000s, and we'll try to test them on newer data sets. We might also try to tweak the data a bit to see if we can find some results that actually make some even better performance, or maybe the same performance with less risk. So keep an eye on the channel. Remember to like and subscribe and all that jazz, and we'll soon come up with more research for you. Thanks for now, and take care of yourself and your money out there. Bye.